Okay, let's unpack this. You're in your 20s, maybe just landed that first real job,
Yeah.
and suddenly the mail is full of credit card offers, or, your friends are talking about points and rewards.
Oh, that feels like a milestone.
It does. It feels like a rite of passage, doesn't it? This whole idea of financial independence often kicks off with that little plastic rectangle.
Mm-hmm.
But should you actually jump in? Is taking a credit card at this stage of your life a smart move? Or is it like a financial trap waiting to spring?
That's the million-dollar question.
That's what we're really digging into today.
It's a question I hear all the time, and it's absolutely pivotal for so many young adults. What's fascinating here is how easily one can be swayed by those initial offers.
To sign up bonuses?
Exactly. The bonuses, the promises of freedom, without fully grasping what they're truly stepping into.
Yeah.
So, our mission in this deep dive is to cut through that noise. We'll unpack the complexities, look at both the significant advantages and the very real pitfalls.
So you can make a genuinely informed decision.
Precisely. Decide whether to embrace this powerful financial tool, or maybe wisely steer clear for now.
Before we get into the nitty-gritty of pros and cons, let's just zoom out a bit. We often throw around terms like credit card, but I wonder if we truly understand its fundamental nature.
Good point.
For those just starting out, or even those who've used one for years, what's the core mechanism we should always remember? It's not just a fancy debit card, is it?
You're absolutely right. It's crucial to understand it's much more than a debit card.
Yeah.
At its core, a credit card is essentially a short-term loan from the bank.
A loan. Okay.
Think of it as the bank saying, go ahead, spend this money now, and we expect you to pay us back in full by your next billing cycle. It's like a bridge.
A bridge between now and payday, maybe.
Sort of, yeah. Between now and when your payment is due.
Yeah.
But here's the critical distinction and where many people stumble if that repayment isn't timely.
Meaning you don't pay off the full balance.
Exactly. If you don't pay off your full balance by the due date, this raises an important question about the true cost of that convenience.
Because interest kicks in.
Very high interest rates kick in. We're often talking about annual rates that can soar to like 30, 40%, sometimes even higher.
Wow, 30, 40% annually? That's huge.
It's a significant cost for borrowing, and it quickly compounds.
That figure is startling. I wonder if most young people, myself included when I was starting out, even fully grasp what that means for a small balance that compounds.
It's easy to overlook.
It really puts that short-term loan into sharp, almost scary perspective. But, okay, the picture isn't entirely bleak. In fact, if you play your cards right, no pun intended,
Yeah.
this little plastic rectangle can actually be a financial superhero. What are some of those superpowers we should be talking about?
Exactly. When approached with discipline, credit cards offer a suite of benefits that can genuinely contribute to your financial well-being and future.
It's about using the tool correctly.
It's about leveraging the tool, not being controlled by it.
Okay, let's start with that often talked about idea of building a credit score. We all hear it's important, but how does starting with a credit card in your 20s really lay that foundation?
It's incredibly foundational.
And why does it matter beyond just future loans?
Well, building a good credit score by using a credit card responsibly in your 20s. It's not just some abstract number. It's a vital financial identifier.
Like a financial reputation.
Precisely. It signals your trustworthiness to lenders. The longer your history of responsible credit use, meaning you consistently pay on time, manage your limits well, the stronger your score becomes.
Okay.
And this score, critically, underpins your ability to secure future major loans. Think of money. Home loans for your first house, or car loans for a reliable vehicle.
The big life purchases.
Exactly.
Yeah?
But here's a less obvious insight. A strong credit score can also impact your insurance premiums, influence whether a landlord accepts your rental application.
Really? Landlords check that.
Sometimes, yes. Or it can even be a factor if an employer checks your financial responsibility for certain roles. It's not just about borrowing. It's about perceived reliability across various aspects of adult life.
That's a powerful point about how it touches more than just traditional loans. It's about opening doors. Beyond that long-term vision, what about the more immediate, tangible perks?
Ah, the rewards.
Yeah, the cash back, the points, are they really worth chasing?
Oh, the tangible perks are definitely a draw, and they can absolutely be worth it if used smartly. Many different cards offer various incentives. Cash back on every purchase, specific discounts.
Or travel points.
Right, or accumulated reward points redeemable for travel, merchandise, or even statement credits. If you're already spending money on everyday necessities, Groceries, gas, streaming services.
Things you'd buy anyway.
Exactly.
Hmm.
Utilizing a credit card that offers these benefits means you're essentially getting a small percentage back or a discount on what you would have spent anyway.
So free money, kind of?
It's a way to make your existing money work a little harder for you, provided, and this is crucial, you're not spending more just to chase those rewards. That's the caveat.
Right. Don't spend an extra $50 just to get $2 back.
Precisely.
And what about safety in emergency situations? Credit cards often get talked about in that context, especially with digital transactions being so prevalent now.
They absolutely do. Credit cards offer a layer of security that debit cards, for instance, often lack. Most come with robust fraud protection.
Meaning if someone steals your number.
Yeah, if your card number is stolen or used without your permission, you're generally not liable for those fraudulent charges, which provides significant peace of mind.
That's different from a debit card, right?
Very different. Imagine your debit card is compromised. Those funds are immediately gone from your bank account, and it can take time, sometimes weeks, to recover them.
Nightmare scenario.
With a credit card, it's the bank's money being fraudulently used, technically, not yours directly from your account. It simplifies the recovery process immensely.
Okay, that's huge.
Beyond that, they can serve as an invaluable emergency net. For those sudden, unexpected expenses, a car repair, an unforeseen medical bill, an urgent flight.
Life happens.
Exactly. A credit card can provide immediate access to funds, bridging the gap until you can access your savings or next paycheck. It's a powerful tool for financial resilience.
There's always a but.
But again,
Well,
only if you can repay it swiftly. It's not free money for emergencies. It's borrowed money.
that fraud protection is a huge, often underestimated benefit, I think.
Ah.
Lastly, on the upside, how can a credit card actually help you understand your own spending habits better, like a built-in financial coach?
Well, credit card statements, believe it or not, can be a fantastic tool for personal finance management. They provide a detailed month-by-month record,
Every single purchase listed.
a full account of your expenditures. This level of detail allows you to easily categorize where your money is going, identify spending patterns, and truly understand your financial habits.
So you can see, wow, I spent that much on coffee.
Exactly. It's like having a built-in accounting system for your personal finances, helping you pinpoint areas where you might be overspending or where you could save more efficiently.
It makes tracking your budget much simpler than trying to remember every cash transaction.
Definitely. Much easier.
So it sounds like a credit card can be a powerful ally. But let's be honest, the whispers we hear are often about the dangers.
The pitfalls.
Where does this great power really go wrong for people, especially for someone just navigating their 20s? I mean, my mind immediately jumps to that temptation to just keep spending.
That's the big one.
Is that truly the biggest trap, or are there more subtle dangers at play for young adults?
You've hit on it. The benefits are only realized with discipline, and the downsides are often lurking just beneath the surface of convenience. And that temptation to overspend is arguably the biggest danger.
Just too easy.
The ease of swipe now, think later is incredibly seductive. Unlike using cash or a debit card, where you immediately see your bank balance decrease.
Ouch, reality check.
Right. Credit card provides a psychological detachment from the actual money. It doesn't feel like you're spending your own hard-earned cash in that moment.
Delayed consequences.
Exactly. This can lead people to spend more than necessary, buying things they don't truly need or can't afford, simply because the option is readily available. It's a psychological trap that catches many.
And if you fall into that trap, what happens when you can't pay the full bill? We talked about that terrifying interest rate earlier.
Yeah, the 30–40%.
Can you elaborate on the debt spiral that can occur and how quickly it can consume you?
Indeed. Not paying the full bill is where those high interest rates we discussed earlier become incredibly punitive. The interest becomes very heavy,
And it compounds.
often compounding monthly,
Yeah.
sometimes even daily, on your outstanding balance. Many individuals fall into a debt trap by only paying the minimum amount due each month.
Which feels like you're doing okay. Right. You paid something.
It keeps your account in good standing, avoids immediate late fees, but it means the principal balance barely decreases. Sometimes it even increases because the interest added is more than the minimum payment.
Oh, wow.
So the interest on the original debt, plus any new purchases, continues to accrue. This is how debt accumulates rapidly.
Like a treadmill.
Exactly. It can feel like you're on a treadmill, running harder but never quite getting ahead, with your debt growing larger and larger over time. It's a cycle that's very difficult to break once established.
And it can take years to dig out of.
Years, absolutely. Serious financial stress.
And that, I imagine, has a direct crushing impact on the very credit score you were hoping to build in the first place, right?
Exactly. The credit score you were hoping to build can be severely damaged if you're not careful. Late payments, for instance.
Just being a few days late.
Even 1 or 2 late payments are one of the most detrimental actions to your credit report. They can cause your credit score to drop significantly.
Making it harder to get those future loans.
Much harder. It makes achieving those future financial goals we talk about, home loans, car loans, much more difficult. It sends a strong signal to lenders that you are a higher-risk borrower.
So they might say no or charge you even more interest.
Precisely. They may either deny you credit altogether or offer it at much higher interest rates, costing you a lot more in the long run. It's a double-edged sword.
Responsible use builds.
But irresponsible use demolishes your financial reputation.
So after weighing those tempting pros and those terrifying cons, the big question for you, the listener, becomes, so what does this all mean for me?
Right, the personal decision.
When is it truly advisable to consider getting a credit card in your 20s? And when is it genuinely best to just hold off? This feels like the most crucial decision point.
This is where self-awareness and honest financial assessment become your best guides. The sources provide clear, practical criteria for making this decision.
Okay, let's start with the green light scenario. When should someone in their 20s seriously consider a credit card?
You should definitely consider a credit card if you can genuinely and consistently spend responsibly. That's number one.
Meaning you have a budget and stick to it.
Yes, you have a solid handle on your income and expenses, and you're disciplined. Secondly, and perhaps most critically, if you are able to pay the entire bill on time every month.
Non-negotiable.
Absolutely non-negotiable to avoid interest. Thirdly, if you have a clear, intentional goal of building your credit score for future financial endeavors. You see the bigger picture.
You're playing the long game.
Exactly. And finally, if you are adept at smartly using the rewards and cashback programs, ensuring they truly benefit you without encouraging overspending.
Using them, not being used by them.
Perfect way to put it. These are the hallmarks of a financially mature approach, someone who sees the card as a tool, not a limitless piggy bank.
That makes perfect sense. It's all about intentionality and self-control. On the flip side, and perhaps even more important,
Yes, the when to avoid part.
when should someone absolutely not take a credit card, even if those shiny offers are tempting?
You absolutely should not take a credit card if you have a known habit of overspending. Be honest with yourself here.
If impulse buys are your weakness.
If you consistently find yourself buying things you don't need or can't truly afford, a credit card will only amplify that problem, not solve it. It's like pouring gasoline on a fire.
Okay. What else?
Similarly, if you experience difficulty with managing your budget, meaning you often lose track of where your money goes or struggle to stick to a spending plan,
If budgeting just feels impossible right now,
then adding your credit card will likely lead to significant financial stress and regret. Get the budget sorted first. And finally, if you tend to spend your entire salary each month,
living paycheck to paycheck.
leaving literally no room for savings, or, more importantly, for credit card repayment. If there's no buffer, then a credit card is a direct path to accumulating unmanageable debt.
So if that's you, just wait.
In these scenarios, it's far wiser to wait until you've developed stronger financial habits and maybe built up a small emergency fund. There's no shame in waiting until you're truly ready.
Excellent advice for self-assessment. Because sometimes the hardest person to be honest with is ourselves when it comes to money, right?
Absolutely.
Now, for those who do decide to move forward, who are confident they meet those should consider criteria, what are the actionable, practical tips for smart usage?
Okay, execution time.
How do you master this tool and ensure it remains an asset rather than becoming a huge liability?
This is where we shift from decision-making to execution, ensuring that the tool works for you, not against you. It's about building good habits from day one.
What's the #1 rule, the golden standard you absolutely cannot break?
The single most crucial rule, and I cannot emphasize this enough, is to always pay the full bill.
Always.
Every single month. No exceptions. Reiterate this as often as possible because paying only the minimum amount, as we discussed, is a recipe for falling into the debt trap.
Slowly but surely.
Slowly but surely, accumulating interest that can overwhelm you. If you genuinely can't pay the full balance, then you've overspent, and you need to reassess your habits immediately.
I love that clarity. Beyond full payment, what kind of budgeting framework can help someone just starting out, especially if they're earning their first consistent salary?
A fantastic budgeting framework to adopt, and one that's incredibly practical, is the 50-30-20 rule.
50-30-20. How does that work?
It provides a clear guide for managing your income after taxes. Allocate 50% for your essential expenses, things like rent, utilities, groceries, transportation. Needs.
Okay, half for needs.
Then 30% goes toward your desires, dining out, entertainment, subscriptions, hobbies. Wants.
The fun stuff.
Right. And finally, a crucial 20% should be earmarked for savings and investments, or maybe paying down other existing debt if you have it.
So 50% needs, 30% wants, 20% savings debt.
Exactly. So if your first consistent salary after taxes is, say, $3,000 a month, that means $1,500 for essentials, $900 for wants, and a critical $600 going straight into savings or investments.
Sticking to this makes managing that credit card bill much less stressful.
Much less stressful because you know you have the funds allocated. It builds predictability.
That's a great, easy-to-remember rule that provides real structure. What about how much of your available credit you should actually use? I've heard about credit utilization being a big factor.
Yes, that's another critical factor for your credit score, your utilization ratio. And it's all about perception.
Perception by lenders.
Exactly. You should always aim to keep your credit utilization low. Specifically, try to avoid using more than 30% of your credit limit at any given time.
So if the limit is $1,000, keep the balance below $300.
Ideally, yes. Keep your monthly spending below that $300 mark on that card. Think of it this way. If you're always maxing out your credit, even if you pay it off each month,
It feels risky.
it can look like you're living close to the edge, potentially in more financial distress. Keeping utilization low is like showing lenders you have plenty of breathing room,
Makes you look more responsible.
which makes you a safer, more responsible bet in their eyes. Better for your score.
And on a more ongoing basis, in this digital age, how do you truly stay on top of things? Because it's easy to just set autopay maybe and forget.
Autopay for the full balance is great, but you still need awareness. Consistently tracking and budgeting your expenses is paramount.
Know where the money's going.
You need to know where your money is going at all times. Use budgeting apps, spreadsheets, or even a simple notebook, whatever works for you.
Find a system.
Find your system to constantly track expenses, and make sure you are staying strictly within your budget limits. Set up alerts for spending thresholds or payment due dates.
Be proactive.
This proactive approach helps prevent surprises at the end of the month and ensures you have enough to pay your credit card bill in full. It empowers you to be in control.
Rather than letting your money control you.
Exactly.
Finally, what about having multiple cards? We see so many different offers out there. Is more always better for rewards, or can it be a pitfall for someone just getting started?
Generally, for someone just starting out, I'd advise keeping it simple. Limit yourself to 1 or maybe 2 cards.
Unless there's a really good reason.
Unless absolutely necessary for specific, well-thought-out financial goals. While different cards offer different rewards, managing several accounts can quickly become overcomplicated.
More chances to mess up.
It increases the potential for overspending or, crucially, missing payment due dates across different cards with different cycles. If you're building habits, focus on mastering responsible use with 1 card first.
Start simple.
Also, consider the type of card. A secured credit card, where you put down a deposit that becomes your credit limit, can be an excellent stepping stone for beginners.
Less risk for the bank, less risk for you.
Exactly. It helps build credit with minimal risk before moving to a traditional unsecured card. Simplify where you can to avoid unnecessary stress and risk.
This has been an incredibly insightful deep dive. It really boils down to whether you're ready to handle this financial tool with the seriousness and self-awareness it deserves.
That's the core of it.
So to bring it all together for you, our listener, what's the ultimate takeaway to ponder as you consider your own financial path in your 20s?
If we connect this to the bigger picture, a credit card is neither inherently good nor bad. It is simply a tool.
Like a hammer. Can build a house or smash a thumb.
Exactly. Its ultimate impact, whether it becomes truly beneficial for you or a devastating debt trap, depends entirely on how you wield it.
It's about behavior.
It's about your behavior, your discipline, and your understanding. Remember the profound thought that underpins all of this. You don't get rich with a credit card,
Definitely not.
but you become smart and disciplined in your financial habits by using it correctly.
So it's a training ground for financial discipline.
It can be.
Yeah.
I encourage you to consider how you can apply this principle of smart, disciplined tool usage to your entire financial journey. Think about that next big financial decision, big or small.
how can you approach it with this newfound clarity?
Right. Making choices that build a strong, resilient foundation for your future.
Yeah.
That's the real power here.